Business Share Plan.
David Burrows is here from Barometer, and Joseph's in Edmonton. Hi, Joseph. Welcome to the program.
Hi. I have a couple of questions on natural gas. It puzzles me why it's so low, and I'm basically wondering if ever there's going to be some catalyst to upgrade the stock. Secondly, why are we leaving $60 million or so of this resource in the ground? Do you approve of its management and future outlook on it? Do you foresee it remaining low, or, as I say, is there going to be something to upgrade the value of the stock? Thank you, and I'll listen to your answer.
Sounds like an Economics 101 conversation.
So, Joseph, yeah, this is a question that's been being asked for a long time. And, you know, I think that it's probably the most asked question in the Canadian market because it matters, you know. The issue here, of course, is that with some of the newer technologies, there's been a lot of natural gas found over the last few years. And for the same reason that I really like energy infrastructure companies, natural gas pricing has been very weak. There just simply isn't enough infrastructure in place to move it from the ground to market effectively. And as a result, there's this big bottleneck, which means we got too much supply and not enough of it being used. Long term, I think that there's no question you ultimately will see natural gas usage go up, and we are seeing it. But the question is, where is the inflection point? So for the long-term theme, I think it's probably early to say that we're onward and upward from here. Having said that, in investing, we look at different time frames. And this time of year doesn't tend to be a bad time to start looking at natural gas because you've gone, you know, partway through summer, you know, winter will come, and in the short run, you could see some net improvement. So we are seeing a little bit of basing out in the price of natural gas. When we look at some of the natural gas stocks, they're behaving a little bit better. Energy as a group, as a sector, oil and gas, is performing a little bit better. So I think you can nibble away a little bit here at some of the bigger names, but recognize that you might be early.
Is there a bigger name in Canada than Encana?
Well, I think that Encana is a great example. I don't know if you want to put the chart up, but certainly the stock's been basing over the last few months. You know, it's threatening to get turned around, and I think that that's really the way you have to look at it. It's a great series of assets, and ultimately, you know, probably there's a good base in place.
So are you suggesting, as you say, nibble at $22, you'd be willing to put like a half position, a quarter position?
Yeah, I think that you'd start with a third of a position and see how we play into the fall. Let me talk the other side. There is risk that this very hot summer we've just gone through, you know, fueled some of the rise that we saw in natural gas pricing, because certainly there was lots of air conditioners running and lots of power being used. So peaker plants were using more natural gas.
All right, let's talk about the other key commodity here with Jim in North Bay now. Hi, Jim. Thanks for holding. What's your question?
Yeah, hi. Thanks very much, Michael. It's nice to see you back where you belong in that seat. David, I've got a question on CNQ specifically, but from where I sit, maybe I can do the other side of what you were talking about with gas. We've got a surplus in world oil right now. We're sitting on top of the shoulder season, and demand across the world is fading. And yet, in the last few weeks, oil has decided to take off. Now, I know you do a lot of statistical data on this kind of area and the work that you do. Why is this happening now? If you can give me your insight into why you see oil at these prices right now and where it is going, and do you have a price target where you would enter into CNQ? Thanks so much.
Okay. So we're going to talk oil first, and then we can talk CNQ specifically. So just quickly on oil. I think that we have to ask the question right now, is the run-up in oil price been driven by geopolitical risk, Iran and Syria, or is it more specifically, you know, because there's lots of demand out there? I think the demand side is weak. And I think the way you can see that showing up is if you look at the price of Brent oil, the world price of oil versus West Texas, there's an enormous spread between the two. And part of that is because we can't get the West Texas to market, you know, the same way as Brent. So all the oil companies are benefiting from higher oil prices. CNQ certainly has, you know, it's run up from 25, it's 30, so it's had a good lift. But there have been lots of these little lifts along the way. So I think that you have to be a little bit skeptical I think that we're seeing some improvement. We would prefer to focus on the oil producers that actually are able to get Brent pricing for their oil, like a Vermilion, right? And Vermilion has a 4% yield, and they're getting the world price for oil. And some of the big Western producers are having difficulty because even the Western Canadian price that they're getting is not even West Texas pricing, again, because they can't get it to market. So the fundamentals largely for demand are still a little bit weak. Geopolitical risk is being priced into oil, and so that's caused a little bump in the share prices.
So you wouldn't be buyers of CNQ today?
We're not yet buyers of the big oil sands companies. All
right. Thank you very much for your kind words and your call, Jim. We're taking a short break. David Burrows is our guest. He's the president of Barometer Capital Management. If you've got a question, 1-855-326-6266. When we come back, we'll get the outlook for Tim Hortons.